Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 8.3 of Unit 8, Price Action Trading. In this lesson, we are going to cover the basics of candlestick patterns, including shooting stars, hammers, hanging men, engulfing patterns, and doji. By the end of this video, you will understand how to identify and use these patterns to improve your trading decisions. Let's get into it. Let's start with the shooting star pattern. This is a bearish pattern that occurs at the top of an uptrend. It has a long upper wick and a small body at the bottom. The long upper wick indicates that the price tried to go higher but was rejected, and the small body at the bottom indicates that the buyers were not able to sustain the price. This pattern is like a warning sign that the trend may be reversing. Now, let's look at the hammer pattern. This is a bullish pattern that occurs at the bottom of a downtrend. It has a long lower wick and a small body at the top. The long lower wick indicates that the price tried to go lower but was supported, and the small body at the top indicates that the sellers were not able to sustain the price. This pattern is like a sign that the trend may be reversing. The hanging man pattern is similar to the hammer pattern, but it occurs at the top of an uptrend. It has a long lower wick and a small body at the top. This pattern is bearish and indicates that the trend may be reversing. It's like a warning sign that the price may be about to drop. The bearish engulfing pattern is a strong reversal signal. It occurs when a large red candle completely covers a small green candle. This indicates that the sellers are in control and the price may be about to drop. It's like a big wave of selling pressure that overwhelms the buyers. The bullish engulfing pattern is the opposite of the bearish engulfing pattern. It occurs when a large green candle completely covers a small red candle. This indicates that the buyers are in control and the price may be about to rise. It's like a big wave of buying pressure that overwhelms the sellers. The doji pattern is a special type of candlestick pattern that indicates indecision. It has a small body and equal length wicks. This pattern can occur at any time, but it's most powerful when it occurs at key levels such as support or resistance. It's like a sign that the market is unsure of what to do next. Context is everything when it comes to candlestick patterns. A hammer pattern at support is much more powerful than a hammer pattern in the middle of a trend. You need to consider the overall market conditions and the location of the pattern in the trend. It's like trying to read a book. You need to understand the context of the story to understand the plot. Now it's time to practice identifying these patterns. Go back on your charts and look for each of these patterns. Mark them and see what the price did after. This will help you develop your skills and become more comfortable with these patterns. It's like practicing a new language. The more you practice, the more fluent you become. Let's review the key takeaways from this lesson. We covered the shooting star, hammer, hanging man, bearish engulfing, bullish engulfing, and doji patterns. We also discussed the importance of context and practice in identifying these patterns. Remember, these patterns are not foolproof, but they can be a powerful tool in your trading arsenal. That is everything for Lesson 8.3, Candlestick Patterns. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.